Welcome to The Deep Dive, your shortcut to cutting through the noise and really understanding what's driving the market. Today, we're taking a close look at a major player's Q2 2025 earnings call. This past quarter's results gave us a lot to chew on, especially around their strategy across different parts of the business and, well, these massive investments they're making. So let's unpack this for you.
That's right. Our goal today is basically to filter out the noise, look at the key financials, what management actually said, and the outlook. It'll really highlight what matters for the bigger picture here.
Okay, let's jump right in with the headline numbers from Q2 2025. The company reported GAAP EPS, that's generally accepted accounting principles earnings per share, the standard profit measure at $1.68, which was, pretty significantly ahead of the $1.32 analysts were expecting.
Yeah, quite a beat there.
And revenue also came in strong, $167.7 billion. The expectation was more like $162.1 billion. So we're talking a solid 13% year-over-year increase, or 12% if you strip out the currency fluctuations.
Pretty robust growth, definitely.
And then operating income, this really jumped out, surged by 31% year-over-year to $19.2 billion. Net income hit $18.2 billion. So on the surface, a really impressive top-line performance, wouldn't you say?
Absolutely. Those are undeniably strong top-line numbers, no question. However, what's interesting is that despite these figures, some details in the segment performance really grabbed the market's attention. It led to a pretty quick recalibration of expectations right after the call.
Okay, like what specifically?
Well, investors really zoomed in on AWS, that's their cloud computing division. Sales growth there was solid, 17.5% year over year, hitting $30.9 billion. But the real friction point, the thing people focused on, was the AWS operating margin. It contracted noticeably.
It contracted how much?
It dropped from a pretty high 39.5% in Q1 down to 32.9% this quarter. That's a dip of 2.6 percentage points. Now, still very healthy margins, don't get me wrong, but that's a significant move down for their most profitable segment.
Right, especially after being so high. And what about the other segments?
Yeah, for context, North America sales grew 11% to $100.1 billion, and international was up 16% to $36.8 billion. Advertising revenue also looked good, up 23% year over year to $15.7 billion. So you see, it was kind of a mixed picture that sent, let's say, clearer signal to the street than just the headline beats might suggest.
Got it. That sets the stage well. So let's dive a bit deeper, maybe start with the core retail business. Management on the call, they kept talking about focusing on inputs rather than just outputs. What exactly does that mean in practice?
Right. So inputs for them are those core things that drive the customer experience. Having the right products, keeping prices low, and delivering things fast. They specifically highlighted, for example, the return of Nike products, which was a big deal.
Yeah, I remember that being anticipated.
And also adding more luxury brands like Aveda, Marc Jacobs fragrances, Saks brands like Dolce & Gabbana, Stella McCartney. It's not just about adding more items. It's about strategically broadening their appeal, kind of moving up market a bit.
Interesting. And what about groceries? They mentioned a perishables pilot.
Yeah, their fresh groceries pilot. Apparently seeing strong uptake, 75% were first-time shoppers, and get this, 20% were repeat buyers multiple times just within the first month.
Wow, that's sticky.
Seems like it. And they also pointed out again that the research firm Profido recognized their prices as the lowest among U.S. retailers for the 8th year running. Plus, Prime Day was apparently their biggest ever. New records for sales, items sold, and Prime signups.
So this focus on input selection, price, speed, what does that tell you about their overall retail strategy?
Well, I think it signals more than just, marketing buzzwords. It suggests a real strategic focus on building deeper customer loyalty and making their operations more resilient. It's about strengthening their competitive advantage, making it harder for others to compete purely on price or convenience. You see other big retailers doing similar things.
Makes sense. Did they touch on broader economic factors like tariffs?
They did. The CEO addressed tariffs directly, said that through the first half of the year, they haven't really seen diminishing demand or prices meaningfully appreciating because of them. They suggested some of that resilience comes from having over 2 million different sellers on their marketplace. Lots of options keep prices competitive.
Okay, that diversity helps. And delivery speed. They always talk about speed.
Yeah, and they highlighted some significant progress there. They've basically re-engineered their U.S. inbound network into a more regional structure. The result? A 40% jump in direct lane orders, meaning fewer stops. A 12% cut in how far packages travel on average.
Less travel time.
Exactly. And nearly 15% fewer times each package gets handled. Think about it. Fewer touches, shorter journeys. It's more efficient. And it means they hit a new global speed record for Prime members, delivering 30% more items same day or next day in the US compared to last year. They're essentially building a superhighway for packages.
Okay, impressive logistics. Now, shifting gears a bit, you mentioned advertising was strong. $15.7 billion in revenue, 22% growth. What's driving that?
Right, advertising continues to be a real bright spot. They're seeing strength across what they call their full funnel offerings.
Yeah.
Basically means they can reach customers whether they're just starting to look or ready to buy.
And where are they reaching them?
Well, they have a huge audience, over 300 million ad-supported viewers in the US alone, across their own sites like the retail marketplace, Prime Video, Twitch, Fire TV. But here's a really interesting development. They announced a major partnership with Roku.
Roku, how does that work?
It gives advertisers using Amazon's DSP, their ad buying platform, exclusive access to reach 80 million connected TV households through Roku devices. This is a huge step into connected TV advertising, bringing better planning and targeting to that space. They also integrated with Disney's Ad Exchange, getting direct access to inventory on places like Disney+, ESPN, and Hulu.
So they're really pushing into that TV ad spend. Seems smart.
Absolutely. It's a massive strategic move. It positions them to really challenge the traditional TV ad players and capture more of those digital ad dollars as viewing habits shift. Now, let's pivot back to the segment that really dominated the post-call discussion. AWS.
Right, the cloud business. Strong growth, but that margin compression.
Exactly. 17.5% growth is great, but that operating margin dropping to 32.9% was the big story. So management explained the compression. They pointed to a few things, mainly a seasonal step up in stock-based compensation, paying employees with stock.
Okay, that happened.
Also higher depreciation expenses. That's basically the cost of their growing capital investments wearing down over time. Yeah. New servers, new data centers cost money. And some unfavorable foreign exchange impacts too. Currency movements hurt them a bit, but they were clear. AWS margins will fluctuate because they are constantly investing in custom chips, new data centers, power.
Which raises the key question, right? Why are they seemingly okay with this margin pressure now? What's the bigger play?
That's the crux of it, isn't it? And the answer seems to be generative AI. The CEO specifically highlighted that AWS is already building a multi-billion-dollar business in Gen AI. He said it's seeing triple-digit year-over-year percentage growth and, crucially, experiencing more demand than supply.
More demand than supply, so they literally can't build fast enough.
That seems to be the message.
Wow.
They're investing incredibly heavily in their own custom AI chips, like Trainium 2. These are the powerful processors needed for complex AI models. Trainium 2 is now underpinning services like Anthropic's newest models and Amazon Bedrock.
Bedrock is their platform for building AI apps, right?
Exactly. Makes it easier for companies to build and scale generative AI. They're also using NVIDIA's latest Grace Blackwell superchips. So both custom and third-party silicons. And they're rolling out new tools, Strands, an open-source way to build AI agents, Agent Core for deploying them securely. Even something called Kuro, an AI coding assistant that uses natural language, is a huge, huge push into AI infrastructure and tools.
Okay, so connecting the dots. The margin pressure is partly due to massive AI investment because the demand is exploding.
That's the narrative. And management put it in a broader context, too. They stressed that even now, something like 85% to 90% of global IT spending is still on premises.
Meaning companies running their own servers, not in the cloud.
Precisely. And they project that this whole equation is going to flip over the next 10 to 15 years. They believe AI will actually accelerate that shift to the cloud. So from their perspective, these current investments, even the ones compressing margins today, are like table stakes. They're necessary to capture this massive decade-long migration wave.
So it's a long-term bet on the cloud shift supercharged by AI.
Exactly. And they also spend time highlighting Project Kuiper. That's their big plan for a network of low Earth orbit satellites.
Like Starlink.
Kind of their answer to Starlink, yes. Designed to deliver high-speed broadband, especially to places that don't have good internet access now. But the key difference, or selling point, is its planned seamless integration with AWS cloud services. And they're aiming for compelling pricing. The commercial beta test is planned for late 2025 or early 2026, and they claim they've already signed up a lot of enterprise and government customers.
So Kuiper isn't just about internet, it's about extending the AWS ecosystem.
That seems to be the strategic rationale, yeah. Extending their cloud reach globally, even to remote areas.
Okay, so looking ahead then, what did they guide for Q3?
The Q3 outlook projects revenue between $174 billion and $179.5 billion. That represents 10% to 13% year-over-year growth. Operating income is guided between $15.5 billion and $20.5 billion.
How does that compare to expectations?
Well, the revenue guidance looks pretty solid, robust even, but the midpoint of that operating income range, it fell slightly below what Wall Street analysts were looking for.
Okay, so maybe continuing margin concerns there.
Potentially. And they also confirmed their capital expenditure target, the CapEx, their big infrastructure spending, is around $118 billion for the full fiscal year 2025. A huge chunk of that, they confirmed, is going towards AI data centers. That spending level is massive, really puts them up there with the biggest competitors.
$118 billion.
Wow.
Yeah.
And this really brings us to that divergence in sentiment we saw right after the call. Management consistently framed these huge AI and infrastructure investments as, long-term leverage, essential for capturing the cloud migration, the AI revolution. They're playing the long game.
But the
market, judging by the immediate stock reaction, seemed much more focused on the near-term picture, particularly that AWS margin compression and just the sheer size of the CapEx checks they're writing. So there's this tension, right, between the company's long-term vision and the market's focus on the next quarter or two. That's a key dynamic to watch.
Definitely. So that sets up some important things for investors or anyone following the company to keep an eye on, right? What are the key catalysts?
Yeah, absolutely. The Q3 results will be critical. Specifically, you'll want to watch the net sales trend within that guided range, and crucially, that AWS margin trajectory. Does it stabilize? Does it improve? Also, any further updates on monetizing things like Alexa, plus maybe at their September devices event? That's been talked about for a while.
Right, making Alexa pay its way.
Exactly. And milestones for Project Kuiper.
Yeah.
Seeing that beta launch actually happen will be important. And then, of course, just how the core retail business performs during the holiday season, especially with any ongoing tariff uncertainty. Plus, any new partnerships they announce around AI models.
So the big question hanging over everything is, will all this massive spending on AI infrastructure translate into real, durable market share gains down the line? Or is it just pushing profitability further out?
That's precisely the debate. And it makes the margin performance over the next couple of quarters really critical for justifying that long-term bull case.
Okay, perfectly summarized. Now, shifting gears completely, it's time for our This Is Not Financial Advice segment. Let's pretend we're pitching an idea to a hedge fund. What's an outrageous but maybe plausible trade based on this earnings call?
Okay, all right. So given how the market reacted negatively, focusing on that AWS margin dip and the huge CapEx, despite the company basically shouting about their long-term AI plans, here's a contrarian idea. A long-term call option spread on this company.
Okay, bring that down. Long-term call option spread.
Right. So basically you're buying call options that bet the stock will go up significantly, but with a strike price well above where it is now, maybe expiring way out in 2026 or even 2027. And to make it cheaper, you'd simultaneously sell call options even further out of the money, capping your potential upside but reducing the initial cost.
And the outrageous part.
The outrageous part is you're betting directly against the market's current short-term pessimism. The market just punished the stock for spending heavily and seeing margins dip slightly in AWS. This trade says that reaction was wrong, or at least short-sighted.
Okay, so what makes it plausible then?
The plausible part is tied directly to that massive AI opportunity, and the cloud migration story management kept hammering. If they're right, if 85–90% of IT spending is still on-prem, and if their $118 billion CapEx does give them a lasting edge in AI infrastructure, then logically, those investments should eventually lead to significant market share gains and eventually re-accelerating margins in AWS.
Making today's margin dip just a blip.
Exactly. A temporary cost of building a dominant position for the next decade. So the bet is that the market will eventually wake up to this, recognize the long-term value being created, and re-rate the stock significantly higher. You're betting on management's long view winning out over the market's short-term focus.
Interesting. A bet against the immediate reaction, banking on the long-term strategy playing out. Got it. Okay, so to quickly recap our deep dive today, the company delivered strong headline numbers, definitely beat expectations there, but the focus quickly shifted to AWS margin compression and the sheer scale of their CapEx, particularly for AI. It highlights that divergence, doesn't it, between management's very long-term investment horizon and the market's more immediate concerns.
That's the key takeaway, and key areas for you to watch going forward are definitely AWS performance, any news on monetizing assets like Alexa, plus A, and the actual rollout and progress of Project Kuiper.
Absolutely. And always remember,
Yes, always remember, the information discussed here on the deep dive is purely for informational purposes. It is absolutely not financial advice. Any investment decisions you make should always be based on your own thorough research and ideally after consulting with a qualified financial advisor who understands your specific situation.
Well said. We really appreciate you tuning in for this deep dive into this important earnings call. We hope it gave you some useful insights. We encourage you to think about what stood out most to you. Was it the scale of the AI bet, the potential of Kuiper, or maybe the near-term margin questions? Lots to consider. Join us next time for another briefing here on the deep dive.